Hello everyone, welcome back. Here is Ali Talabi and this is module 13, or capital asset pricing model. In module 12, we talk about diversification and how you can reduce the risk of your investment by adding more assets to your portfolio. And we wrap up, we talk about two different type of risk: systematic risk, also called market risk, and unique risk or unsystematic risk. And we mentioned that diversification works to some degree. So there is another form of risk, the systematic one, which you cannot eliminate. And I promise I'm going to talk about this type of risk in this module. So in this module, we'll talk about the market or systematic risk, and I will show you how we can use beta to measure that type of risk. And we will link the risk measured by beta and the expected return by using the CAPM or capital asset pricing model. And also in this module, I will walk you through the steps you need to take to estimate the beta. So I will use a real example and I will show you how you can get the data from Yahoo Finance. You can actually export to an Excel sheet, and you can simply calculate the beta for any company which is listed in the stock exchange. So let's start our first lesson from this module. So when we talk about the systematic risk, we mentioned that we are talking about the market risk. And when you're talking about the investment, based on the investment, based on the risk of the investment, you need to be compensated. So the risk impacts on the risk premium, and based on that, you ask for a specific level of return. So in other words, we can argue that the expected return on a specific asset depends only on systematic risk. Why? Because we are able to diversify our portfolio. We can eliminate the risk in the firm level or the unsystematic risk. So the focus should be more on systematic risk. Again, no matter how much total risk an asset has, only the systematic portion is relevant in determining the expected return for the specific asset. So the standard deviation, which we argued in the previous module, is not relevant anymore because we learned that the standard deviation actually considers the total risk of your investment. But we know that the market risk is more relevant because you cannot diversify that, so you should include that for the return you expect. So as a good manager, you should be able to diversify your portfolio so we can eliminate the unsystematic portion. Now, how we measure the systematic risk? If the standard deviation is not appropriate, we have to introduce another actually measurement for that. So we are using the beta coefficient. What is the beta coefficient? Again, it helps us to measure the relative systematic risk of any investment or asset. So it shows how risky is our asset and how well it is moving with the market return. So the beta of 1 is for the market, which means your asset is moving in the same direction, same significance of the market. If the beta is greater than 1, it means your investment, your asset is more volatile than the market. And if your beta is less than 1, it means you are actually taking less systematic risk than the market, and therefore it's less riskier. Again, the beta is a good indicator of the risk, and based on that, we can estimate the expected return. Higher beta, higher expected return; lower beta, lower expected return. So let's talk about the formula and how we can actually measure the beta. There are several ways we can calculate the beta. One is using the correlation between assets and the market return. So we know the historical market return, or we know the historical stock return, and based on that, we can calculate the correlation and the standard deviation for both assets and the market. So again, remember the beta is showing how closely the market and the stocks returns are correlated. Or in other words, we can say how volatile the security is relative to the market. So as you see the formula here, we can use this formula, so which is based on three factors: the correlation between the stock return and the market return, the standard deviation of the stock, and the standard deviation of the market. That's one way we can measure or calculate the beta. The second approach to calculate or estimate the beta is using the characteristic line. What is the characteristic line? It is showing the relationship between the market return and the stock return. So if you have if you look at the two dimensions, one dimension here will be your market return. Let's say that's your independent variable, your horizontal axis, and your vertical axis or dependent variable in this case is your stock return. So we want to see for different time of year, for example, on daily basis or on weekly basis, what is the market return and what is our stock return. So you can actually illustrate that in a graph, in a line, which is showing the relationship between these two returns. So the slope of this line will become your beta coefficient, because again, the slope is indicating how well the stock return is moving with the market return. So in the next lesson, I will talk in more details how you can actually use the actual data from Yahoo Finance and also the Excel file to estimate the slope of this line, which is your beta coefficient. Now, we're able to measure the beta either using the formula, the covariance formula, or the characteristic line. So what? I mentioned this beta, which is used to measure the risk, is relevant because it helps us to estimate the expected return. So how we can link the expected return and the beta? Now here is the role of CAPM. The CAPM is talking about the relationship between the beta systematic, which measures the systematic risk, and the expected return. So the expected return for any asset is based on the beta coefficient, the market risk premium, and the risk-free rate. You already talked about the market risk premium. The market risk premium, that's the difference between the expected return and the risk-free rate. So in other words, if you know three factors, the market return, the risk-free rate, and the beta coefficient, you should be able to estimate the expected return for any specific asset. Remember the graphical representation of the relationship between the systematic risk or beta and expected return is called SML. So whenever you heard about the security market line or SML, it just shows the relationship between beta and the expected return. So we'll talk about SML in a bit. Now, if you talk about the total risk, which we mentioned before, or a standard deviation, we measure the standard deviation to measure that. The relationship between the standard deviation and expected return was called CML. So I see many students that get confused between CML and SML. CML is capital market line, showing the total risk and expected return. SML or security market line showing the systematic risk or beta and expected return. And here our focus is on SML. So let me talk more about SML. So here is an example of the SML or security market line. As you see here, the horizontal axis is showing your beta, which is measuring the systematic risk, and the vertical axis is showing the expected return. So here we have the line. So this line is the line I mentioned. So it is this SML security market line. The slope of this line is your market risk premium, which is ERM or expected return on the market, and the risk-free rate. We know the market has the beta of 1, and based on that, you can say this is the expected return for the market. So for sure, we can refer back to the formula, to the CAPM formula, which is showing the relationship between the market risk premium, the beta, risk-free rate, and the expected return on the market. So the CAPM is estimating that for any specific level of beta, for example, let's assume your beta is here. So you have an asset which has a beta of almost half or 0.5. So based on CAPM, your expected return for this asset should be here. So this is the expected return for asset I, given that specific beta. Now, if you are moving upward, or in this case rightward, you see that actually if your beta, for example, let's say for stock J, your beta is 1.5, you should expect much higher return for this stock. Now, maybe you say, Ali, is it always true that based on the beta I can estimate the expected return? Is it actually in the market where we see the same kind of pattern? The answer is no. For sure, you can find some cases which we have undervalued or overvalued a stock. So what does it mean? It means that you can find some assets or some stocks which are either above the line, above the SML security market line, or below the line. So what will happen in this case? For example, what will happen if you can find a stock which is here. So let's assume this is a stock K, and a stock K has this beta, which is for sure greater than 1, and this is the expected return for this specific stock. So if that's the case, based on the CAPM, your return should be here. You see, your return should be here. So there is a gap between what CAPM is estimating and what is the actual expected return. So in this case, we'll say that a stock K is undervalued because it provides higher expected return than the risk. Or in other words, we say the stock K has alpha greater than 0. What is alpha? Alpha, that's the difference between what CAPM is estimating for the expected return and what actually you expect to receive. So the gap here you see, that's alpha. For our case, stock K has the positive alpha, so it is undervalued. What if your stock is below below the security market line? So let's assume you have a stock L here. So you see that based on CAPM, if you are having this level of beta, so let's call this beta L, if this was beta K. So if your stock is here, so based on this level of beta, the CAPM is estimating you get this expected return. However, actually you are getting this expected return. So you have the alpha, which in this case is negative, is less than 0. In other words, you can say the stock L is overvalued because it provides less expected return than what the CAPM is actually estimating. So the alpha becomes negative for the case of L. If you are anywhere in the line, we can say that alpha is 0 and the price is correct. So the stock or the asset is correctly priced. The expected return is what actually CAPM is estimating. So that's it for this lesson, this module. Last lesson of this module 13, we'll talk about beta estimation. So I will show you how actually you can use the real case, real example to estimate the beta. Till then, have a wonderful day. Talk to you soon. Here is Ali Talabi, and take care.